What's going on? What's going on, Outliers? Happy Sunday. We're doing a little bit of a change of pace here because there's not going to be any live streams tomorrow. There might be one on Tuesday, TBD on that. And then there might be one on Wednesday. Also, oh, no, I lied. There's not going to be I don't know about Wednesday. Who knows? Who really knows? I do know there's not going to be one tomorrow. That's for sure. So, yeah, the game plan is to do our standard market kickoff live stream and talk about what's kind of coming up for the week ahead. I'm in between packing a little bit, so this one will probably be a slightly abridged version, but we should still be able to get through a ton of stuff. So that's the game plan here. Now, for those that will see, I'm on it now. I know it's going to do it. So I'm ready to click back in as soon as it's got to happen. Let me grab the chat. Say hello to everybody, and then we'll start running through everything. How's the weekend? Everybody enjoying themselves? I ended up doing a little bit more of an aggressive workout tomorrow. I'm looking at my phone because there's another piece of news that came up. Israel strategic gains, the quiet impact. Hold on, got to read this. Of Iran attack. Let's see what this says. This is from Alpha Inspiration, and it says Israel's recent attack on Iran's military infrastructure has garnered significant attention, but the strategic gains Israel has achieved through this operation are often overlooked. Iran's response has been a focus of global discussion. The quiet impact of Israel's strike on the regional balance of power is worth examining. Israel's attack on Iran's nuclear facilities and military bases has exposed vulnerabilities in Iran's air defense and missile production capabilities. By targeting these facilities, Israel has disrupted Iran's ability to support its regional proxies, such as Hezbollah and Hamas. This disruption has weakened Iran's influence in the Middle East, shifting its regional balance of power in Israel's favor. Okay, so, yeah. I think they're just talking about like the strategic selection of targets, which is noteworthy, I would argue, because a lot of people were expecting a slightly different targeting package than what they kicked off with. But that's a conversation for another day, I suppose. So we got Tommy, we got Ricky, Beach Bum, Reese, Liz, Silly Russian, what up? Ricky says this week's going to be wild. What do you have going on this week, Ricky? What's on the agenda? We also have Lauren here. That's fantastic. We love that. Toby runs a lot. Don't run too much. Running too much is not good. It's hard to get into hypertrophy if you're out there running around a whole lot. I mean, right now I'm doing everything I can to maintain any mass I have with my extremely sad workouts for the past 13 weeks, but we're still getting it done. No matter what, still getting it done. Okay. So let's start with a bit of a flexible grid here, because there's a couple things that I think are worth looking at together. And I'm going to swap bonds out here. We could keep bonds. No, let's swap bonds out. Let's put crude oil. And then let's put gold over here. So when we see today's open, I literally got a series of alerts on the phone right at 1500 Pacific time, right as things started popping off. And MCL or just CL, whatever, crude oil of your choice. You can use whichever you prefer. Toby runs a lot, says, let me guess, it is bad for your knees. I mean, everything's bad for it. I'm just joking around. If somebody likes running, run, man. The main thing I just think is most people that I know that get really into running or endurance sports, they shed all of their muscle mass. And not everybody needs to be super interested in being, bulky and jacked and that kind of stuff. But if you listen to any of Peter Attia's work, there's actually a really strong correlation between longevity and muscle mass. And it's something that is, it's like protective of all of your physiological processes in the long run. So he talks about like this Centurion marathon or decathlon, whatever the fuck it's called. So yeah, my comment was just mostly in jest, but I like to run too. But I actually like to like actually run. Most people, when they say run, they mean go for like a 5-mile jog. But I like doing like 880s, 400s, 200s, 100s, 40s. I like that kind of stuff a lot. I've always been more of an explosive athlete than, yeah, I mean, because even in the Marine Corps, we would do like 5-mile runs, 7-mile runs. And like, I was always okay, but your boy wasn't out there having a great time. It was always just, let's finish this fucking thing so that it's done. And then we can go to the gym and try to get back out of a catabolic state and find our way into an anabolic state, ideally. So looking at oil's start today, though, this was a little surprising to me. Oil was down already as much as 5%. Right now it's like over 4.5%, and it looks like it's settling down a little bit. This surprises me quite a lot, but I actually really enjoy this gap down because I'm not in oil right now, and this offers a beautiful potential entry if it can start getting its feet under it, because this low gapping down quite this far is a little excessive, but we'll have to dig into that a little bit more. Reese says, how do you feel about holding into earnings? It's a great question. Obviously, the cheat answer is whatever your plan says, but that's kind of a superficial answer in this context. But I do think it's relative. Hey, that's a new way. Instead of me saying it depends, I get to say it's relative. It's relative. Didn't say it depends. It's relative to what you think about the ticker. So like, joking aside, if I had a stock that I was going to hold for 5 years, I don't give a shit if I hold through earnings. Like, I really don't. If I'm planning on holding it for the long term, my brain doesn't work that way though. It's not frequent where I want to hold something indefinitely for even a year. Even year periods is too long for me. But that's because the way that I make money trading is by reducing drawdowns. That's a big part of what I do as a trader. So that part aside, I suppose it's completely okay to hold it through earnings, but you just have to be willing to deal with the consequences of whatever it is post earnings. And whatever it is would change my thoughts, right? Because if we're talking about holding something like Tesla through earnings, Tesla can be all over the place now, like literally all over the map. Whereas if you're holding something like GE or Microsoft through earnings, they don't really move that much. So I think another part of it is just what's the individual ticker that's being held, because I feel a little bit differently about that. Cool. So what's going on so far with futures? I added a little bit more risk in the E-minis because they're showing a bit of an uptick, which is good. Let me run gold here. Yeah, man. So yields are what? Pushing up again? Yeah, yields have been nuts. Look at this. 4.25. This has been relentless. Seeing yields run like this is also really interesting because right now equities are up and tech is leading the pack. Tech is up 0.6%. Interesting. All right, let's get down with some news. Okay. Crude oil futures fell Sunday after anticipated Israeli airstrikes did not hit crucial oil facilities. Yeah, like how does this? What's the soundbite here? Ah, I see. See, this is the market as a discounting mechanism. That's really, really interesting. So what this is saying is the run up that we saw in oil last week, which I mean wasn't even that crazy if we're being honest about it. But what they're speculating is that the run up in oil last week was in expectation of infrastructure being damaged. I find that interesting because the move over last week was 68. Thor, shut the fuck up. 68 and 3/4 to 71 and 3/4. So it's like not even that big of a move. This looked like a half-assed move by oil if it was in anticipation of some like actual infrastructure being hit here. Yeah, that just doesn't seem too significant. And my guess is if they hit some significant oil facilities, this thing would have flown. Tommy says, what was the weekly move ATR in oil? Let's see. So ATR 5-day was 374 compared to 421 on a 20-day time frame, compared to 345 on a 90-day time frame. So a downtick relative to the last month, but the last month had some pretty banger days. Yeah, that's interesting. Lauren says, what does ATR stand for? Average true range. So ATR is slightly different than ADR. AT, Tango, is average true range. ADR, Delta, is average daily range. And what these measure are like the stock price movements within set time frames. So, for example, if we look at average daily range, that's looking at the range for the day. Average true range includes the gap between days. So you'll capture periods where the average daily range might be very, very tight, but then if there's a big gap following it, average daily range might show pretty light, whereas average true range would show the expanse of that move. So slightly different ways of looking at volatility for, different trading reasons. Now, ADR is actually a pretty significant filter that I use when I'm looking for breakout and momentum style plays, because a lot of times I want things that are moving a lot more. Michael says, you think markets will sell off since the strike on Iran, and looks like gold selling off? Yeah, I mean, markets are up right now, though. E-minis are up about half a point. Russell is up. Qs are up. So, I mean, who knows? Like, that's also one of the things, right? Like, the way that the market opens today on Sunday, futures open, is very different than what it could look like tomorrow. But my immediate reaction would be, if I thought that there was going to be some sort of large scale sell-off from the airstrikes, I think we would see it in futures now. And the fact that we don't leads me to believe that even though if the market does open down tomorrow or trails down tomorrow, always a possibility, I don't think that that's necessarily a significant artifact of the airstrike itself. Because again, like if there were concerns about it, we would kind of see it at this point. Tommy says, you use ATR to help with finding short deltas or only use IV? It's not so much short deltas. Short deltas is a different thing. I just use ATR and ADR for volatility. Like it's just another way to visualize volatility. Like essentially you can see Bollinger Bands here. Like these are Bollinger Bands just in a label format, because you can essentially say, for example, here, if we go back 90 days in NASDAQ, the daily range was 1.77, whatever that turns out to be. Then if we go back the last 20 days, it's 1. Oh, I forgot. We have our handy dandy drawing tool. Let's grab this. So like, let's just pretend, I don't know what 1.77 actually looks like here, but let's pretend that this is 1.77. And this is the, what am I looking at? The 90 day. Then if I look at a 20 day, this is the range, 1.42. This is 20 day. Then if I look at a 5 day, it's this, 1.3%, 5 day, right? So if I were to put Bollinger Bands on this, that's what you're going to see. You're going to see wider Bollinger Bands here that have been slowly trickling in, getting tighter over the data. So it's just a way to visualize that without having more stuff on the chart. It's obviously not perfect. Bollinger Bands give you a slightly different view. Not saying that there's no use for them. It's just a different use. It's kind of duplicative for what I have here. Now, finding short deltas is completely different. That's looking for, you know, things that are going down or things that are inversely correlated that are going up. So I don't care so much about ADR, ATR when I'm looking for short deltas, which right now we're kind of at a point where short deltas start to look kind of good. I mean, not like massively important, but kind of good. Because if I take a look at my portfolio, and we'll talk about more of this on the pro session at 5 today, because I need to go through everything and I need to make a bunch of updates. But like right now, I don't really need a bunch of short deltas. I have a couple. Yeah, I have a couple, but I'm mostly trend following right now. I'm not looking to carry stuff short. See, and this is a common breakdown in approach for people. So a lot of times they'll want to carry short deltas so that when there's a downturn, so that they don't feel shitty about themselves. So that when there's a downturn, they're not like, oh, you know, this sucks. I don't like this. And the problem with that is there's a cost related to carrying short deltas, and it's drag on your returns. So what I like to do actually is slightly different, and I use trend following as my exit protocol. I eat the loss, and then if things start to roll over and actually show continuation to the downside, then I will put on short deltas so that I can actually opportunistically trade it to the downside. It's not so much, I'm not trading short deltas typically to offset long risk anymore. I used to do that if I was heavily levered. And if there was, like, let's say, for example, perfect example, this weekend, let's say that last Tuesday, for whatever reason, I got really heavy long equities, heavy, and I'm leveraged at this point. Coming into the close on the weekend, if I'm choosing to carry that levered position through the weekend, I can't logically carry that leverage through the weekend without some sort of hedge, because I face blowout risk. Because based on what happened with Israel and Iran, let's say another scenario happened. Let's say Israel domed Iran. Iran got pissy, hopped in their old tanks that are really rusted, can't drive that far, and they started trying to drive over to Israel, breaking down the whole way. It would be like really screechy, tough to listen to be honest. It would be sad to watch, but they would be, you know, they were doing the best. And for those that don't like fossil fuels, you'll hate that, because that's just a shit ton of diesel in these old Cold War era tanks. So they're there squeaking along, breaking down left and right, trying to get over to Israel. And then Israel, they just start lobbing more bombs and drones, and then shit starts escalating, right? So if that scenario happened, then the open that we saw now could be very different. The open that we saw now could be very bad. And the problem with being heavily levered in either direction is that you don't need a 15% down move to have a catastrophic drawdown. Not necessarily, depending on how levered you are, but not necessarily catastrophic to the effect of you're blown up, but it's a large drawdown, that's for sure. So going back to the original point, carrying short deltas for me is very selective. I'm either opportunistically trading things to the downside because they're going down and I'm going to follow the trend down just as I follow the trend up. Or if I am going to carry short deltas, it is going to be for a very specific purpose, meaning I am jacked to the tits holding this leverage through a weekend. And because we know that we have some noisy neighbors right now that are not getting along, I am logical enough to understand that there is the potential, whether it's Russia and Ukraine. Guess what? That war's still going on. Something could pop off there where NATO gets involved, or North Korea gets more involved, or China gets involved. That starts escalating shit. That can be bad for an open. So if you're leveraged, you have to pay very close attention to geopolitical risk as it sits, economic risk. All these other risks become very, very important. And then you have to have some sort of risk control parameter. Now, the cool part is during the week, it's less of a problem because with futures, you just get out. Even if it's after hours, you just get out. No problem. Liquidity is not going to be great, but if something starts popping off and markets start moving, liquidity will be there. That's not so much the case when we get our first open on Sunday afternoon. So that's the idea of like short deltas in a nutshell. Tommy says, how does this relate to BB squeeze that might show volatile price? I need to look that up again. I have some old studies on Bollinger Bands, but let's see what we can find. This is an old one that I've shown you guys before. There's this one. And then there's this one. The reason why I'm saying that is because the premise behind a Bollinger Band squeeze constricting is that as things constrict, then you expect price to open up at some point. But I'm just not convinced that that's actually that efficacious. And it might be because again, it's been a while since I looked at this stuff. But let's just do an eyeball test together. Let's pick something like Tesla. And then let's add Bollinger Bands. So what I'm doing is I'm just eyeballing price movement relative to the width of the bands. Not so much do the bands widen out. We know the bands will widen out as price widens out. There's no debate. But really what I'm interested in is how predictive are these periods here where the bands get tight before they start opening up. And then let's take a look at something like Microsoft. We'll have to do a little bit of homework on it and actually measure the width of these bands and whatnot. Whenever I use Bollinger Bands, not to be clear, I like Bollinger Bands, but whenever I use them, I actually use them more for the midline and then the upper and lower lines for, again, trend following. I don't care so much if it gets super, super tight, but I wait for clean breaks and then I try to follow the price relationship between the two halves of the band. That works pretty well. So this, I think, doesn't necessarily do the same thing, but neither does this, because you need to have some sort of relative benchmark for it. That's the important part with any of this stuff, right? Because you can look at something like Microsoft and you could say that the 5-day average day range is 171, the 20 days 152, and then the 90 days 172. So that's actually why I have a 90-day average daily and average true range in here, to give me context on what the longer term looks like. But realistically, I would want it to be even longer if I was going to use this like this. I would have like 180-day, something that represents about 6 months. And the way that I would use that is I would compare these different periods, specifically the front period, to that longer term period. But I don't really have this set up to do that. So I think it could be done, but it's not the way that I typically use Bollinger Bands in terms of the predictive capability of the squeeze. And it's not the way that I have these set up now. But here I actually want to see if we can find anything quick about the squeeze. First, we use different versions of squeezes. Yes. Other than the breakout method, specifically recommends another method of using Bollinger Bands to squeeze. Without a doubt, the most popular Bollinger Bands topic. The standard version of the squeeze will generate a buy signal under two conditions. Price breaks the upper or lower band, and bandwidth drops to 6-month minimum. Yeah, okay, so I like this. The use of this makes sense, right? Because it's normalizing it over a period. I love that. Big fan. Squeeze method only generates a signal at point B. Yes. The gradually decreasing predictive power is consistent with the use of the squeeze method. The squeeze method generates significant positive returns in 9 markets in both the full sample and the first subsample, the number of markets reducing to 7. Yeah. So this is exactly what I thought. This is precisely what I thought. This is the key takeaway. And again, I have to look a little more at the study. This isn't me reading this sentence and being like, oh yeah, they're right. I've read a ton of studies on this, and this falls in line with the breadth of research that I have on the topic, where essentially as things become more popular, they become less efficacious because more people use them. And what this is telling you is that back in 1983, it showed positive returns in 9 markets. Then it dropped to 7 after 83, and then now it's at only 1 after 2001. So it doesn't necessarily hold super true anymore. So yeah, you can check these studies out for yourselves though, and see what you think. And then the second question from Tommy is, what about following trends by combo for a ratio call diagonal, ratio put diagonal, and stay market neutral? That's trying to have your cake and eat it too. I don't blame you for wanting to do that, but it works poorly. So I'll show you that. And the reason why, because I actually did a study on this specifically for the leveraged T-triple-Q coverage strangle that we're doing. I didn't care so much about SSO, doesn't matter so much in there, but T-triple-Qs, I thought that was a cool idea. So let's model what I have now. Again, this is the pass-through account, so there's nothing in it, but I can model the coverage triangle as it sits. So right now we have 2 Hyundai shares. $200. And we have these at 73.84. We got to get rid of all this other stuff from here. Okay. And then we have the 15 Nove. Ooh, these are coming up on time to manage. Glad we're looking at this. We have the 67 puts. And we did those for 305. And this is the exact trade that I have on right now in the sample coverage triangle portfolio. Then we also have the 69s giggity, and we got those for 255. Why are these sucking wind right now? That's bullshit. And then we also have the 80s. We have one of these. We got these for 214. These are underwater too. Yo, T-Triple-Qs is just being a fucking hater right now. How am I down on both the put and the call side at the same fucking time? The disrespect. This is the problem. This is the problem I have with the stock market. It's very disrespectful. The stock market can just, it can, I literally am losing on two opposing sides of the trade right now simultaneously. Just straight disrespectful. Tommy says IV expansion, definitely. Jokes aside, that'll be exactly what it is. And it'll be really from this day. Now, again, joking aside, it should be down by now, especially starting up this weekend. I would expect that to collapse. Yeah, see, like IV's actually been coming down, but it's just straight the disrespect, because apparently they don't care, right? That Lawrence says, don't these stocks know who you are? Seriously, I thought they would know that we have Thor as a portfolio manager who's very difficult to please. He actually threw up on my bed earlier today. Wasn't stoked on that. And so now he's laying down in recovery and he's not happy. And wait till I tell him about this. Wait until, well, he's right here. He can hear me, but he's knocked the fuck out. So he's going to be livid that we're losing on both sides of this trade simultaneously. Just love that for me. Anyways, let's test out Tommy's idea. So this is with a covered strangle. I'm going to kill all of these for now, and then we'll look at ratio put and call diagonal combined. We'll do it on a 90-day basis. So let's grab like a 65 delta, like those, and like these. And then let's sell some short-term puts and calls against. I'll up that to 2 in a second, but just let me get these off. And then 30 is here. And then 2. So the issue with this is that you will never see a fill at these prices. That's the primary problem you're going to face here. Now, normally what will happen is this center part will be down here. And then there's a period where you actually can introduce tail risk to either side versus risk that is more designed to help us. So imagine this is down here. The entire premise of a ratio call diagonal or ratio put diagonal is looking for an extreme move or looking for a directional move, right? So in this kind of example, if I thought I didn't know which way TQs was going to go, but I thought it was going to go one way or the other big, I wouldn't sell anything against it. I would literally just buy the straddle and then let it go whichever direction I don't know it's going to go. I find as a trader, it is such a better practice to get used to coming up with the directional assumption. Just make a fucking choice, right? Do I actually think T-Triple-Qs is equal probability to go up or down? I personally don't. It's going to exhibit positive drift as it tends to do. So that's the way that I look at it. Tommy says, I was thinking ratio call diagonal in utilities and ratio put diagonal in materials. Yeah, I mean, you could do something like that for sure. But again, I would think of them as two separate things because you're trading two separate things at that point. Now, one of the things I have tinkered with is for something like this is grabbing, especially for something like T-Triple-Qs, is buying a longer term put as part of the equation here. But you'll notice that if I get rid of everything else and I get one of these puts, I decrease, let's say the negative 15% move, I would lose $1,300 as compared to 2138. right? 13 versus 21.38. And then if I did 2 of them, I only lose 560 to the downside, but then I only make 1,040 to the upside to the 15% move. Whereas here I make 2,318. Again, this goes back to the point of make a choice. Because could I put on something like this that would decrease my maximum downside to $500? I can. But then it also starts drastically decreasing my total profit potential. I don't really want that. And then there's an even bigger problem with this approach with buying puts. Does anybody know what it is? Any guesses? And then I'll show you. And then we'll take a look at a quick scan of the market before we wrap up. Puts are expensive. That's part of it. But that's not the part that I'm leaning towards now. What other guesses do you have? I'm updating all my little scans. Theta decay? Nope, that's not it. Because technically I could sell these options against it, right? I could consider the sold puts to offset the theta decay. So in this case, what were we sampling? Getting the 83s? The theta on those is like, call it $4. And by just selling 2 of these puts, I cover more of that. There you go. Tommy's got it. The market tends to drift up. That's a problem. Why is it a problem? Because here's the deal. As the market does what we want it to do, because we're holding long deltas and we want it to go up, as it goes up, guess what happens to the buffer it provides, the losing part of my trade? It decreases the buffer. You start to be able to lose more and more money because right now stock is at 74.80, right? So the distance between where we're at today and max loss is very narrow. Right now, let's just call it, it's showing negative $42. And then max loss is $638. So like $600 loss. That's what you could take here. However, if the stock starts rallying all the way up here, and let's say that we're holding a really nice profit at 24.33. Well, now our max loss is capped at 638. But guess what? You give up all of that $2,400 and then 638 on top of that. That's money you could have had. It's an unrealized gain, but you're still giving it up. So then in order to prevent that, you got to move the put up. When you move the put up, it's going to be for a loss because you would have bought it. It's going to be worth less because it's gone up. Then you got to sell it for less and buy another one. So that's the tricky part. And again, this is why I prefer to use position sizing and trend following versus carrying hedges. You can carry hedges. There's nothing that says, there's no rules. But I know from a practitioner standpoint, it absolutely is suboptimal. I know that for a fact. The reason why hedges become so attractive is because people are used to hearing like hedge fund managers and people like that. But the problem is for a hedge fund manager, they have a lot of rules that they have to follow, even if it's a closed-end hedge fund and that they have more free reign. They still have bigger positions that they have to move around. It's not easy for them to just flatten their position if things start to roll over and then get back in if it starts going back up. If you're putting on tens of millions of dollars in a trade, it takes days to do that. It's not something that's just done super fast. So it's a different fight is what it boils down to. It's a pretty significant different fight. Silly Russian says, just want to thanks for looking at my Geo Motion script earlier. Yeah, for sure. I didn't actually go through this script, just to be clear. I don't want to get credit for something I didn't do. But I did read your comment on it, which was very cool. I love that. And I love that as a project for you. And when we were talking about the use of different forecasting for future price modalities, there's a bunch of them that are obviously interesting. Geometric Brownian motion is kind of like, to your point, simple to do. But again, depending on what you're trying to get out of the exercise, if it's to understand that stuff better and visualize it and just kind of play around with ideas, then that's totally cool. But if you're trying to use like a broad, simplistic, generalized approach to something like that, then it kind of loses its ability to actually help you, right? Because it's a little too generalized. That's why I think something like Garsh, eGarsh, EJ-Garsh, that includes some sort of jump diffusion. That's one of the big issues with geometric Brownian motion, is trying to catch jumps. And depending on what you trade, jumps will have a bigger, or, you know, not necessarily as big of a component, but still important. So yeah, I love that as a project. I think that that's super, super fun. So big fan that you're doing that. Tommy says, if market tends to drift up, what about selling leap puts and also getting favorable tax treatment? That's not how I sell puts. Like, yeah, you know how I sell puts by now. There's a bunch of issues with that. If you come super far out in time and you sell a put here, let's say you use a 30 delta, you're now on the hook for this trade to make $1,265, whether you have margin or not, right? Meaning depending on how much the margin requirement is. You're on the hook for until 16 Jan 26. Over the course of that time, a lot of things can happen, and you're capturing quite literally the slowest version of theta decay that you can find. You're going to get $2 per day in theta. $2 per day. Let's go to 145, the 30s. Let's see what you get here. Advancing to $3 per day after you go from 446 days to 82 days to expiration. So after holding, you know, for 350 days or so. Then at 54 DTE, those 30 delta puts, they give you 6 cents. So you start doubling your theta decay once you get within 54 days. Again, this is the standard theta decay curve. So I don't see any positive to that personally. There is actually a post on Reddit that I commented on about a similar version. Somebody has like shares of Tesla actually, and they were talking about like how they're making, you know, because they have like a $5 million account or something, and they're able to make like $200,000 by selling these puts. And they're trying to use that for income. The problem with that is that sooner or later, those puts will become a problem, meaning the market's going to rally against you a bunch. That doesn't mean that you're at the end of the world, right? You can always buy more shares if you're so inclined, but there goes your income. And then if you want to defend them by rolling and stuff like that, well, you really can't do much if they're super far out in time. So then you just kind of have to wait and see what happens. And if it continues to grind down lower, your ability to roll as it does come into time is going to be diminished. You're going to have to wait longer because there's going to be less extrinsic value that will come out of them. So then your ability to generate more income, this is for the person on Reddit, is really negatively impacted. Very difficult to do. So there are conditions where it would make sense, but typically speaking, it doesn't make a ton of sense in my opinion. Yeah. BK says, I saw that Rabbit comment and that's what brought me to your channel. Just saying, well, welcome to the channel. Yeah. And because I totally understood what that dude was talking about. I've been there myself, because I really thought that selling premium was like this big secret that was going to help me simplify what I'm doing. And it does to a degree, but it doesn't to a bigger degree. And I find literally just continuing to trade to be much more efficacious than trying to play that game, again, from a personal perspective. All right, let's see what's coming up this week. We have consumer confidence, job openings, GDP. That will be important. GDP is on the 30th. PCE, 31st. Manufacturing PMI on the 1st. That will be important. Both from S&P and ISM. So it looks like a mid kind of week. There's nothing there that's like jumping out at me as catastrophic, gonna be massive impact to the market, but definitely things that do stand to potentially move the market. And then let's take a look really quick at the calendar. And let's see what we have coming up for earnings. Tomorrow after, we have Ford and Waste Management. Then on the 29th, BP, DHI, GLW, so a ton of stuff. JetBlue, McDonald's, Pfizer, PSX, Phillips 66, PayPal, SoFi, AMD in the afternoon, CMG. Yeah, so big earnings. This will be a big earnings week. Lots of opportunities there. We'll take a look at a couple of these on the next live stream. Right now earnings have been a overall okay play, but actually not as good as a lot of the breakouts that I've been finding, which is what I want to spend some time looking for in a little bit, because I have a handful of breakout plays that are on. I have a couple that I've taken down for losses that were not working. We went over a couple of those recently, actually. And yeah, most of what I have, 1, 2, 3, we're also going to need some variance risk premium. That is for sure. Need some VRP in our lives. And then SMR, that's one of the breakout plays that are on now. Let's take a look at that really fast, and then I'm going to pop off. Yeah, this looks great. This still looks good, even leading into earnings. This one I sold a call against it, though. So not many, but a pretty light ratio, just because I'm expecting it to settle down going into earnings. And then we have to see how it looks through earnings. It's very bullishly positioned. Let's see how that leads. When is its earnings? The 7th? People hedging to the downside for earnings, though. 4,500 puts against 2,000 calls. This is like a really low float stock, so there's not a lot going on in here. Although the 15 nov is stacked to the upside. So that might be people playing. It's hard to tell. It's hard to tell. It does look like some positioning to the upside, though, for the 15 nov expiration. So we will see. All right, gang, I'm hopping off for a few for the Outlier Pro folks on Patreon. I'll see you guys in like 40 minutes. Got to go finish packing, be an outlier. I will see you all later. Enjoy the week.